Welcome to my channel. In this video, I'm going to talk about cryptocurrency liquidity. What is it? How does it affect the market? And why is it so important? I'm excited to share this information with you, so let's get started. The crypto market is notoriously volatile. 1 minute, prices are soaring and the entire world is talking about crypto. The next, markets have crashed and new investors are scared off. However, if you've been reading up on this space for any length of time, you'll know that things aren't all bad. Prices will undoubtedly rise again and new investors will enter the market sooner rather than later. The only question is, when? In order to predict the future performance of your digital assets, it helps to understand everything there is to know about liquidity. Read on for a complete explanation of what crypto liquidity is and how it can help you make smart investments in this space. What is cryptocurrency liquidity? Liquidity refers to the ease with which assets can be turned into cash. In other words, a crypto's liquidity is its ability to be sold and converted into cash without a loss in value. Liquid assets are essential to any economy. You can't run a successful business if you can't sell your products. In the same way, an illiquid asset will hold back the progress of a cryptocurrency. If it's hard to convert an asset into cash, businesses will find it difficult to operate and investors will find it difficult to exit their positions. This is why liquidity is so important. It determines how easily an asset can be turned into cash. Crypto liquidity isn't as straightforward as it is in the real world, though. A simple transaction won't be enough to turn your digital assets into cash. Instead, you'll need to find somebody who's willing to exchange your crypto for what they want. The more liquid an asset is, the easier it is to find a buyer and complete the transaction. Therefore, the greater the liquidity of your crypto assets, the easier they will be to sell. How does crypto liquidity work? The main factor in determining crypto liquidity is market demand. If a crypto has a lot of buyers, it will be easier to turn it into cash because people want it. If a crypto has a lot of sellers, it will be harder to turn it into cash because people don't want it. Essentially, the market for a crypto asset is like a huge game of tug-of-war. The more people who want to buy a crypto, the more likely sellers are to accept it as payment, and vice versa. The second factor is exchange volume. The more people trading a crypto, the more liquid it is. Investors who want to turn their crypto into cash can find willing buyers by trading through exchanges. If there's a high enough volume, you'll have no trouble finding a buyer for any crypto asset. The more liquid an asset is, the more valuable it becomes. This is because it's far easier to exchange it for what you want. For example, it's much easier to exchange $100 for a new pair of shoes than it is to exchange $1,000. The more dollars available, the more shoes you'll be able to buy. The same principle applies in crypto. The more liquid an asset is, the easier it is to exchange for what you want. Limiting factors in crypto liquidity. There are a few factors that can limit crypto liquidity. The first is the availability of exchanges. If you try to exchange your crypto for a non-liquid asset, you may struggle because there aren't enough exchanges trading the asset. If you try to exchange a crypto asset that isn't very liquid, you may also struggle to find a buyer because the asset has very few sellers. Even if you have a crypto that's highly liquid, you may have difficulty finding a buyer if there aren't enough exchanges trading it at that moment. There are thousands of crypto exchanges, but not all of them trade every crypto. You may be able to find a buyer for your crypto, but you'll have to look online or travel to a city with an active crypto community to find a willing seller. How does crypto liquidity affect the market? The amount of liquidity in a crypto market has a significant impact on the general market sentiment. If investors are confident that they'll be able to turn their crypto into cash easily, they'll be more likely to enter the space and push prices up. However, if investors have difficulty turning their crypto into cash, they're unlikely to enter the market and prices will fall as a result. Crypto liquidity is important because it affects the market sentiment. If an asset is easily convertible, investors will be more likely to enter the market and purchase crypto, driving prices up. However, if an asset is illiquid, investors will stay out of the market, driving prices down. Bottom line. Crypto liquidity is the ease with which you can turn your crypto into cash. The greater the liquidity of your assets, the easier they will be to sell. The amount of liquidity in a crypto market has a significant impact on the general market sentiment. If investors are confident that they'll be able to turn their crypto into cash easily, they'll be more likely to enter the space and push prices up. However, if investors have difficulty turning their crypto into cash, they're unlikely to enter the market and prices will fall as a result. Crypto liquidity is important because it affects the market sentiment. If an asset is easily convertible, investors will be more likely to enter the market and purchase crypto, driving prices up. Thanks for watching this video. Don't forget to subscribe and click on the notification bell.